Good evening, everyone. Today we have with us Mr. Pratik Oswal, Chief of Passive Business for Motilal Oswal AMC. We are here to discuss the NFO launch of Motilal Oswal Diversified Equity Flexicap Passive Fund of Fund. Over the next 40 minutes, Pratik will help us understand why investors should consider passive investing, what makes this fund distinctive, and the ideology and the strategy behind it. So, Pratik, thank you for being with us. And we will begin with a very few basic questions about passive investing and then move on to the details of NFO. Okay.
Thanks for having me.
Of course.
And
So
yeah,
yeah, no, of course. I hope you had a everything was fine with you over here
yes,
coming over here.
absolutely.
Okay, lovely. Let's start then. Okay, there are a few just general questions about passive investing for the starters. So Pratik, what exactly is passive investing and how does it differ from the traditional active approach?
Okay. Yeah. When it comes to mutual fund investing,
Hmm.
there is two styles of fund management.
Hmm.
One is called active, the other one is called passive. In active, you have a fund manager who takes a call about which stock to buy, which stock to sell.
Hmm.
The role of a fund manager is to maximize returns and to take bets into stocks that will go up and sell the stocks that will go down.
Correct.
So that's called fund management. So active funds rely on fund managers. The point about index funds or passive funds is that there is no fund manager. You're
Hmm.
essentially investing into a strategy that is replicating the index.
Correct.
So a lot of investors have heard about Nifty Sensex. These
Hmm.
are two very popular indexes. And the idea behind index fund is that when you invest in a index fund, you're essentially getting the same returns as the index. So if the index goes up by 10%, your fund also goes up by 10%.
That
This is
is
called passive
passive.
investing.
Okay.
So Sensex and Nifty are two large cap passive funds. Today you have passive funds across all categories. You have passive funds across mid caps, small caps. You have gold, silver, commodity funds. You have international funds like Nasdaq, S&P 500. You have say sector funds like IT and pharmaceuticals, and so there's
A lot
basically
of them.
hundreds of index funds, ETFs available. So today investors can really choose whatever strategy or fund they can choose. So that's the concept about index funds. The reason why index funds, ETFs are very popular is because they're very low cost. So the expense ratio is very low. The second is that they're very easy to understand.
Hmm.
So you'll never ever have to underperform the portfolio. So performance over the long term is not a problem. And third is what we've seen is index funds, if you look at it from a long term perspective, have delivered really good returns. Now you're looking at close to 12 to 15% returns plus, depending on which index you buy.
So
So they're
for
becoming very popular today.
Okay, so for passive, like there's no fund manager. There's just a strategy, plain basic strategy, and the stocks are just swapping between as the that period comes up when there's a swap, right?
Yeah, so that period is called the rebalancing.
Correct.
So basically what happens is if you're investing in a Nifty 50 fund,
Hmm.
and what are you buying? Suppose Reliance in a Nifty 50 index has a 8% weightage.
Hmm.
So if you buy the Nifty 50 index fund, the
Hmm.
index fund will have a 8% weightage to Reliance. So basically you are replicating the index completely. And what happens is that every 6 months there is
Hmm.
a rebalancing period.
Okay.
What that means is so when you buy a Nifty 50, you're buying the top 50 stocks of India.
Hmm.
What happens is maybe next quarter stock number 45 becomes 60.
Hmm.
So essentially there's a period of rebalancing that happens where you'll always buy the top 50 stocks at all points in time.
Correct.
So for example, if you look at the Nifty, say 2005, Nifty was infrastructure, oil and gas. Today the Nifty is financial services, IT. Tomorrow it might be something else. So you're always essentially buying the top 50 stocks at all times. So it's ever evolving strategy.
That's all about passive indexes, passive investing, right? Okay. So when we think of passive investing, Sensex and Nifty 50, as you said, immediately comes to our mind. But has the passive universe expanded, and today are there more meaningful choices from investors? Do you think?
Exactly. So there are over. So we at Motilal Oswal AMC have about 62 strategies.
Oh,
So some of them are same but different formats, index fund versus ETF, which we'll talk about later on. But basically, there are hundreds of index funds. In fact, you can create your own index fund today. So you can really, bet on whatever idea
hmm,
you want. So suppose, people want to bet on defense fund.
hmm,
There is a defense index also where you
correct.
can bet on all the defense stocks. Suppose you want to bet on only quality stocks. There
Hmm,
is a passive fund that only buys quality stocks. So there are many options today for investors who are looking at passive, but majority of the demand tends to happen in the very simple products like a Nifty, like a large cap passive fund or a mid cap passive fund. Or I mean, last 1 year, gold and silver has been quite popular.
correct.
So those are also, passive
Metals,
funds. Yeah, commodity.
non-metals. Okay. Lovely. And Motilal Oswal has been seen as a pioneer in passive innovation. How do you see the investor? How do you see the Indian passive investing evolving over the next decade? Like, do you see any penetration over there? Or how's it?
Yeah, so if you look at the category of passive, um, it has grown from under 1% of the mutual fund industry to currently over 18% of the mutual fund industry in the
Oh,
last 10 years time. It used to be a 5,000 crore sort of total AUM
market cap.
combined of passive funds was 5,000 crore 10 years back.
Hmm.
Today it's about 12 to 14 lakh crore.
Oh,
You know,
there's a huge penetration.
so the industry has had a huge growth in the last 10 years time. We've obviously benefited from that growth because we've been there. But essentially today most investors
Hmm.
today are looking at allocating about 10 to 15, 10 to 20% of the portfolio towards passive and the rest between active. Now, if you look at globally, passive is very large. For example, in the US, almost 55 to 60% of the mutual fund industry is passive. Same in Europe. So basically, it's actually, if you look at the number one category of mutual funds in the world, number one would be passive. And then, active obviously comes much. So it's a very large category where there are large amount of funds. And India also we're seeing a lot of progress there. So we are looking at an industry where we should be about 20 to 20, maybe 23, 24% passive in the next 5 to 7 years time. So you're looking at a very large part of the mutual fund industry.
I also see as a discipline in the action over here because this brings a lot of discipline. In active funds, I feel at times discipline is compromised just to go through that. Let's choose these kind of stocks and XYZ. But when it comes down to passive investing, I think it's all about discipline, isn't it?
Yeah, I think discipline, consistency are both there. Unlike the US, where there is not a lot of alpha,
Hmm.
so the benefits of an actively managed strategy is not there
Hmm.
because most funds, about 90 to 95% funds, actually underperform the benchmark.
Oh,
So best
correct,
strategies by passive.
correct.
Unlike the US, India is still not there. India, I think there is an opportunity to create alpha, but also have the simplicity part in the portfolio. So according to me, I think having a mix of active and passive funds in the portfolio is actually the best strategy. Today, most investors have a very low allocation towards passive. So my advice would be have maybe 15-20% allocation to passive.
Okay.
Now, for an investor who wants to invest, say a 35-year-old
Hmm.
who wants to invest for the next 20 years or 25 years,
Hmm.
it's very hard to choose a actively managed strategy because it's a very long-term horizon.
Hmm.
But if you're looking at passive, it's much easier because you can just buy the index. You'll never do badly. The fees are very minimized.
Hmm.
And also, we've seen the track record of passive funds being 15, 20 years. So I think from anyone looking at it from a long-term perspective or from a perspective of keeping life simple, so today there are about, say, 150 mid-cap funds in the country, and choosing the right mid-cap fund can be quite daunting. Might
Correct,
as well just buy the mid-cap index, and you're done. You don't have to worry about finding the right fund.
correct.
So I think that's where passive really does well because it's a very simplified way of investing. And I think that's why a lot of people are opting for it.
I was just about to ask you that if is the active versus passive debate really an either or choice, or both approaches can coexist effectively and in an investor's portfolio. So you actually have directly answered me that
Uh-huh.
it can coexist directly, I would say. And this one's for a younger generation that is watching us, younger audience. Have you noticed a shift in investors' behavior, especially among young investors like Gen Z, towards greater acceptance of passive funds? And if yes, then what's driving this change?
Yeah, so I think younger investors tend to stick towards the more speculative sort of stocks and FNO. Um, my view is that the younger generation likes the philosophy of simplicity in their portfolio. So yes, there is a little bit of adoption towards this index funds, ETFs, but also the problem with the younger generation is a lot of FOMO
Hmm.
effect when it comes to investing, and also their ability to take risk
Hmm.
is high, but a little bit too high. you know so I think I mean the advice would be to obviously build a long term portfolio where you're able to take a bet for the next 3 to 5 years time. Right now the problem we see, especially younger investors, is that their expectations are very high, so
Hmm.
they want to make returns of upwards of 30, 40, 50%,
Hmm.
which honestly I've never met anyone do. So
Correct.
it's something which is really not possible, to be honest,
Unrealistic, totally.
over at least consistently. And because if it was possible, then we would do it in a building because we've spent our entire lives doing nothing but this. So I think the point here is that, if you really want to create wealth,
Hmm.
we've seen there's only one way, and the one way is to really think long term, is to have a strategy where you're able to pick any mutual fund, good mutual fund, and stick to it for 3, 5, 7 years. I think that is should be the dominant strategy in your portfolio. In fact, I keep telling the younger investors is that if you want to trade, trade. If you
Hmm.
want to do FNO, do it. Saying no is very difficult.
Correct.
I think everybody has the urge to speculate. There's a scratch to speculate. So I would do it, but do it with a small part of your portfolio.
Hmm.
So if you have a portfolio of say 10 lakh rupees, maybe you can put 8 to 8.5 lakh into long-term mutual funds, which will compound at say 12 to 15%, which is very good. And maybe the 10, 15% you can do your speculative activity. And if you do well, then you can expand it. 95% of the case, you probably will not do well. So I think, but it's there to, satisfy your urge and also to learn. So I
Correct.
would say that's good because then you're not ruining long-term capital appreciation through, I think doing intense trading. So I think that long-term nature is something which we really drive hard.
I've also heard that in the recent trends there have been there's a trend in thematic funds as well. Do you think it's a right approach that one should be following, or how is it?
Yeah, so I think, if you look at the US and
Hmm.
their thematic funds have been there for quite some time,
Hmm.
20, 30, 40 years. I feel like, thematic funds is for two reasons
Hmm.
you would want to buy thematic funds. One is that if you don't know whether you should buy HDFC Bank or ICICI Bank,
Hmm.
buy the bank index.
Correct.
Simple.
Correct.
You are playing a sector, you're
Hmm.
playing a theme without having to play a stock. So that's one way. The second one is that if you're truly bullish,
Hmm.
but that bullishness has to be super long. So when I
Correct.
say a diversified equity fund, you want to give it 3 to 5 years minimum. A thematic fund is super cyclical. So when it does well, do really well. When it do
Right.
badly, do really badly. So I would say if you're looking at thematic fund from investment purpose, then look at it for at least 7 years. So I would say the time horizon should be a lot higher because of how cyclical it is.
Correct.
Most people, and by most I mean 80 to 90% of the people, tend to chase returns, which is the opposite of what you do when it comes to thematic funds.
Hmm.
Say suppose tomorrow IT is done very well, people tend to come in IT after it's run, and that is the worst time to invest in thematic funds.
That is
So,
so.
yeah, so I would say thematic funds actually end up, if you want to buy thematic funds, as I said, it's a good way of not taking stock specific risk. The second way actually is a good way to actually buy the bottom, guys.
Hmm.
If a theme has not done well, if you're able to buy bottom, then that can be. But you have to really give it that 7 years minimum, 7 to 9 years for you to create wealth, and you also have to have a high risk profile. So most investors in thematic funds are not able to handle the volatility that comes with thematic
Hmm.
funds. So if you are a high risk investor, if you have a long term horizon, I think those are two important things to think about or to really ponder if you're
Hmm.
looking at thematic funds.
Okay, that's great. This question was from a personal side. It was not written over here, but I just wanted to ask you, personally. Well, being said that, I had few NFO specific questions for you, Pratik. So investors are often, torn between the large cap stability, mid cap growth, and the small cap upside. How does this fund simplify that decision through a single or a structured allocation?
Yeah, so this is actually one of, if I had to buy an index fund today,
Hmm.
I actually would buy this one. Why? Because if you look at traditional index funds, and traditional flexi funds, let's take out those two.
Hmm.
Traditional index funds are very large cap heavy, obviously, because you are giving size weightage. And large caps are not bad. It's just that in India, large caps do not have the same earnings profile as mid and small caps.
Hmm.
So an index fund that is mid and small cap makes a lot more sense.
Hmm.
Second is flexi-cap funds. We believe that most flexi-cap is a very, very, I would say, flexible strategy in the sense that the fund manager can do whatever they want.
It's a
They can
dynamic.
have 100% small caps, 100% mid caps, but most flexi-cap funds tend to have a 70 to 75% exposure to a large caps. Same problem.
Correct.
So we believe that, your future returns should be invested in stocks where the earnings growth is highest.
Hmm.
And earnings growth tends to be highest in mid and small cap. So we thought that we could launch a flexi cap fund, which is very simple. where investor gets access to one third of the portfolio large cap, one third mid cap, and one third small cap. So it's a very disciplined way of really playing large, mid, small, where you're getting the simplicity, low cost, transparency of passive funds, while also getting the growth of mid and small cap. And what we've seen, this portfolio actually outperforms.
Hmm.
So even though it's a passive fund, so it's a collection of passive funds, it's shown that in the backtest, it's actually outperformed, say, traditional indexes like Nifty and Nifty 500. So I think it has the outperformance of actively managed funds. It has a construct of passive funds, and it's very simple. If you look at your portfolio now versus 10 years from now,
Hmm.
it'll be the same. You'll have one third in large, one third in mid, one third in small. So I think uh, the simplicity is what we really like about this fund, and which is why I believe that this is one of the best options for anyone looking at, say, an index fund strategy today.
So is this equal weightage applied only at the market cap level or also across individual stocks within the
No, so
portfolio?
just market cap. So just category level.
Okay.
So basically large caps, mid cap, and small cap. So if you look at India, the way large, mid, small are calculated, the
Hmm.
top 100 stocks in India are large caps. Stock number 101 to 250 is mid caps,
Hmm.
and 250 to 500 is small caps. So we are essentially creating a fund that invests into a Nifty 100 index,
Hmm.
which is a large cap index.
Hmm.
One third into Nifty mid cap 150, which is a mid cap index, and a small cap 250 index, which is a small cap. And we
Okay.
would, divide into equal parts. The idea behind this is to obviously, diversify you across 500 stocks, but also what you're doing is you're diversifying across different sectors. And also what we're seeing is that, small and mid, large, mid, small tend to also work in different cycles.
Hmm.
So we've seen the past where when mid caps are bearish or mid and small caps are not doing well, large caps do well.
Hmm.
Or when large caps are flat, mid and small cap tend to do really well.
Hmm.
So by combining all three, you're creating actually a very good uncorrelated portfolio, which does extremely well over long-term horizons. So I think that's the trick and the simplicity behind the fund.
Okay. Actually, I was about to ask you that only that the fund follows a disciplined and rebalancing approach.
Yes.
Is this a mandatory quarterly rebalance? And can you explain how does this mechanism naturally align with the principle of buy low and sell high?
Yeah. So the rebalancing is one of the USPs of this fund,
Hmm.
where you'll always have a one third, one third, one third at all times.
Hmm.
But you would rebalance it quarterly, but the rebalance will only happen if there is a substantial movement from its target exposure. So
Hmm.
suppose say large caps is 33%. Only this 33 falls to 28 or goes up to 38 will be rebalanced. Otherwise, we'll just keep it the same
Correct.
because we don't want excessive rebalancing, excessive costs, and all of that. So what we're seeing is that because we have a 5% band on both sides, this portfolio has been rebalanced only 7 to 8 times in the last 15 years, according to the backtest. So it's a very low churn, and I think it also takes into account valuation changes. For
Hmm.
example, if small caps crash by 20%,
Hmm.
we would automatically buy more small caps, which is buying low. Now, if small caps go up by, say, 40, 50, 60%, they become very expensive.
Hmm.
So we automatically sell small caps, which is selling high, and buy large cap, which is buying low.
Correct.
So this mechanism of buying low, selling high happens all the time. And I mean, it's called rebalancing alpha, but we're trying to, create this concept called rebalancing alpha. We believe that part of the alpha actually comes from this buy low, sell high concept.
Okay. That's really great, Pratik, actually. Many flexi-cap funds talk about diversification, but end up being largely large cap focused. So, how does a true one-third allocation each at large, mid, and small caps? Why indices create a more balanced outcome according to you? Like, are we going to be actually at a point of time when we are going to be largely large cap, or do you think the diversification will always stay at?
No, so we are keeping it one third at all times. It will never, a large cap allocation will never go beyond, say, 38%, and will never go below 28%. We'll keep it the same for life. So investors can expect a very consistent experience in this fund. So what we see, what if you divide, and the beauty about this is that this will never be the best fund, but
Hmm.
this will also not never be the worst one. So you will never be
Right.
anxious about whether you should sell it or not, or whether you'll ever be disappointed whether you should sell or not. So you'll always be in the middle, which is where it becomes easier to hold on to it. So, if you're a very high performing fund, money comes in, but you're scared about how you'll do next year.
Hmm.
Whereas if you're a very bad performing fund, then you'll obviously figure whether you want to sell or not. But if you're a mid tier or slightly above mid tier, then you will stay invested for a long time. And if you're consistently there, then you will create some alpha. So
Correct.
we believe that the experience is very consistent. You'll always be in the top sort of in the middle pack in terms of performance. And that gives you a very smooth and consistent experience if you're looking at your portfolio over time.
Okay, that's really great. And also, Pratik, so mid and small caps are engine of innovation, but can be volatile as well. So why do you believe this time it's an opportunity for investors to adopt an unbiased market cap diversification strategy?
Yeah, so I think mid and small cap is we believe not as risky as what most people think.
Hmm.
Why do I say that? If you look at mid and small, most people are scared that mid and small cap is very risky. Now, if you look at mid and small caps today versus mid and small caps, say 6 years ago, which is not a very long time back, 6 years ago, an average small cap company in India was 4 to 5 thousand crore market cap. Today, an average small cap company in India has 20 to 25,000 crore in market cap. So they are the mid caps of yesterday. And an average mid cap company in India has 60 to 80,000 crore market cap. And they are like large caps of yesterday. So the beauty about buying in mid and small is not only are you getting a sliver of the market, which is where earnings growth is the highest, and long-term return is linked to earnings growth. It's very simple. If you want to invest in a good company for 5 years, its return will be linked to what earnings it delivers. So mid and small cap earnings are great. Earnings are good, while the risk is not as bad as what we saw 6 years back. So we almost feel that investors should actually take a bolder bet today in mid and small caps because they've become a lot bigger. They have a lot more institutional participation. It used to have poor governance. Today, it has very good governance, good companies, good business models. Most of the new age companies, whether getting IPO, are happening in mid and small caps. So you're getting access to new business models there, whereas large caps are pretty much. So I think overall we believe that this fund offers the advantage of having a very consistent strategy, but also a higher allocation towards mid and small cap, which is where returns will be high and risk is not as high as what we had before.
Do you think valuation is a concern?
So if you look at small and mid caps, small caps have almost 60% of small cap stocks, nobody talks about it, are down by 20% or more in the last 1 year. Almost 33 to 35% of mid cap companies have fallen by 20%. So we believe that you're already investing in a space which is down by about 20-25%.
There has been a cool down.
Yeah, so I feel like you're getting it at a very good price. Yeah, valuations have come down by 20-25%. They are somewhat in line with long-term averages. And now, we're also seeing a huge turnaround in corporate performance. We're expecting a lot of good numbers coming in over the next year and a half. So we believe that it's not only a good strategy for the long term, but it's also a good strategy to get in now because of the correction we've had in mid and small cap. Because the market has been flat, but mid and small cap actually gone down the last 1 year.
So I think that so it's not like small cap valuations and mid cap valuations. If it's high, then all the stocks might be high. Few stocks might be that which might be undervalued from the median, right? So yeah, of course there might be few probable.
It's a very diversified strategy where you are investing into 500 companies. You are not taking any concentration risk. So the largest holding will be like
Correct.
1-2% of your portfolio. So essentially, you're a very diversified strategy where you are exposed to 500 stocks and you're getting a strategy which does extremely well during bull markets, where mid and small caps as well.
That's the beauty of Flexicap, I think.
Yeah.
A common concern with fund of fund is that perception of double cost. Can you clarify how the TER structure of this FOF remains cost efficient despite investing in an underlying passive fund?
Yeah, so there's two layers of cost, and we've made sure that both layers combined are the same as an index fund. If I had to launch it as an index fund separately, the cost will be exactly the same. So for example, if you're investing in this fund, your cost attached, if you bought an index fund, which is a single fund, versus an FOF, would be exactly the same. So that's why we ensured that even if you buy this FOF versus you buy the underlying funds, you're actually paying almost the same cost. So there's no double charge happening in a very big way. Second is that when you're buying individual funds and when you rebalance them, what happens? You pay tax because you're buying things. Here, getting a rebalancing structure inside a solution. So there's zero tax involved in rebalancing. So you're essentially getting something which self rebalances. You're paying zero tax. So you never have to really make any changes. You don't have to think about rebalancing. You don't have to think about churning. You don't have to think about performance. So overall, it's a much more tax efficient structure compared to buying individual funds. That's why I think investors should not be worried about the double costs.
Okay, that's I think it's a huge thing I would say because I haven't read about it before, but yeah, it's a huge thing I would say. Finally, would you position this fund as a core long-term equity allocation for investors, or is it better suited as one of the holding in portfolio along with the other funds?
So this is a fund which can be part of your core portfolio for life.
Okay.
It's like you can invest it and forget. It can be part of your long-term allocation. You don't have to worry about it for 5, 10, 15, 20 years, even more.
Mm.
It's something which will continuously compound. It's low cost, and
Mm.
we believe that it's very effective in long-term wealth creation because you're not really betting on fund manager or returns or performance. You're essentially investing into three passive funds, and all three are very basic, very simple, and very easy to understand. So we believe this can be a part of your core allocation where you can put in say 10-15% of your portfolio. So most people in India would be allocated to at least one or two Flexicap funds.
Mm.
So one of them could be this fund, one passive, one active. Again, this fund is also good for anyone interested in Flexicap because, as I said, your traditional Flexicaps are mostly large cap oriented. So this offers a good level of differentiation because this would be, two-thirds mid and small cap.
Mm.
So it offers a good profile of diversification to your existing flexi cap as well.
Okay, I think Pratik, with this, I have winded up all the questions that I wanted to ask you today. But with this, we also have few questions from the audience, I would say. So there are a few questions with me, if I may, because I also have the live stream over here with me.
Go for it.
Okay. So there's first question for you. How is this different from a normal FlexiCap mutual fund that we already see on platforms?
Yeah, so this is a very different strategy. So traditional flexi cap funds are, as I said, um, mostly large cap oriented, 70
Hmm.
to 75% large cap.
Hmm.
Mid and small cap will be about 17 to 20% max.
Hmm.
This one is close to 65 to 70% mid and small cap. And that's where the growth is.
Hmm.
So it's more growth oriented flexi cap, which will probably deliver slightly high returns. The second, this is a passive. So there is no active management,
Hmm.
completely passive. You're investing into a large cap index, a mid cap index, and a small cap index. So it's a very easy, and economical way of getting access to the stock market. I keep telling investors is that the reason why we love mutual funds is because equity is an asset class which will give you the highest returns,
Hmm.
and across all asset classes. And mutual funds simplify equity investing. Mutual funds give you a solution to how to buy this asset class. But index funds simplify mutual fund investing.
Correct.
So it's the simplest way of owning the highest performing asset class in the world, which is equities,
Okay.
through passive flows.
Okay. I think that answers it very simply, I would say. Also, there's another question for you. Is this fund okay for someone who is already investing in index fund, or is this meant for new investors only?
Yeah, so I think if you already invested in an index fund, I think it really depends. I think which index, to be honest. But if you're investing in, say, a Nifty 500, then maybe this fund is fair. I wouldn't say similar, it's slightly better. So this would ideally, we expect it to maybe 1.5% more than a traditional passive fund. But again, the risk is also higher. So I would say that investors who are already invested, I think it's Nifty 500 or a broad-based fund is good enough. But if you don't have an index fund or portfolio, I think this could be the one.
Okay, okay. There's another one as well for you. What is the right amount to invest in it?
Yeah, so I would say 10 to 20% of your portfolio, of your equity
Okay,
portfolio. So we believe that every investor should not have more than 7 to 9 mutual funds in their portfolio. So this could be that one fund that does about 10 to 15, maybe maximum 20% of your portfolio. And it can be the flexi cap, it can be the
hmm,
core allocation,
hmm,
where you will buy and forget. So I think that's the part of the portfolio that this fund could really play a large role. And yeah, long-term horizons. So I think you will never have to worry about performance or ups and downs and or any of that. So it's fairly stable and could be placed in a portfolio for a very long time.
that's the last one for you. I would say. सर ये फंड लॉन्ग टर्म के लिए ठीक है क्या? और मिनिमम कितने टाइम के लिए इन्वेस्टेड रहना चाहिए? दिस इज द लास्ट क्वेश्चन आई हैव रेड।
हाँ हाँ, तो वही सेम क्वेश्चन है। तो हमारे हिसाब से ये फंड है, बहुत ही स्ट्रेटेजिक फंड हो सकता है आपके पोर्टफोलियो के लिए।
हम्म।
ये ऐसा फंड है जहाँ पे आप 10 से 20% का आपका जो पोर्टफोलियो है उसमें आप डाल सकते हो। ये है पैसिव फंड है, तो लो कॉस्ट इफेक्टिव है। और हमारे हिसाब से ये एलोकेशन भी बहुत ही सिंपल है, जहाँ पे आपको पूछना नहीं पड़ेगा कि मेरा पोर्टफोलियो लार्ज कैप में कितना है, मिड कैप में कितना है, स्मॉल कैप में कितना है। आपको पता है क्या है और वही होने वाला है, वही इट्स गोना बी द सेम फॉर लाइफ। सो आई थिंक ये जो ट्रांसपेरेंसी है और कंसिस्टेंसी है, वो ये मतलब स्ट्रेटजी का यूएसपी है। तो आई थिंक इट्स अ गुड, अच्छा है मतलब पोर्टफोलियो के। एंड फॉर एनीवन लुकिंग एट अ सिंपल पैसिव फंड जो स्ट्रेटजी है, ये अच्छा ऑप्शन है।
Okay, lovely. That's it, Pratik, for from my side as well as the audience, I would say. Thanks, guys. And that's all about NFO that is going to be launched. And if you want any more details, you can definitely check out the link in description. Thanks for your time. Have a good evening. And thank you, Pratik, for being with us today.
थैंक यू।
Thank you, guys. Thank you.